Income Tax 2020 Tax Software Example, Itemized Deductions, Schedule A Overview. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software in order to follow along, although I think they do have a free 30-day trial. So if you have access to a demo version for a free 30-day trial, it can be a good tool to be practicing with. We're going to be focusing here on the Form 1040 and the Schedule A, jumping back and forth from the data input to the forms, the tax software making it easier to do so as we run different scenarios. Our starting point is going to be our single filer for Eric Smith, living in Beverly Hills 90210, 100,000 W-2 income. We have the 12,400 on the standard deduction, which we are then going to take a look at as it might change as itemized deductions clear that basic threshold. If they get to that point, that gives us the 87,006 on the taxable income. If we see that in an income formula format or tax formula, we've got the income 100,000, 12,400 at the standard deduction at this point, and then the taxable income. So now we're going to think about a situation with the itemized deductions, which we're going to put on this schedule in terms of our tax equation formula, these itemized deductions being greater than the standard deduction, and that's what we're looking into at this point. So if we go then back to the forms, we're going to be concentrating then on line 12. Line 12, as you can see, says we have the standard deduction or the itemized deductions, the itemized deductions being on Schedule A. Which one would you take, one or the other? You would take whichever is higher because the deductions are good for tax purposes. So therefore, we need to have a decent idea of what the standard deductions are. So from a practical standpoint, what's going to happen, or how do you know whether you should itemize or not if you're working with a client? Typically, you'll look at last year and you'll say, well, did they itemize last year? If they did, that's a significant indication that they may well itemize this year, and something, of course, you want to take a look at. If they did not itemize last year, then you want to take a look at significant factors that may push them over to itemizing, such as possibly a purchase of a home, resulting in a home loan interest and possibly property taxes. You also might want to consider how close to itemizing they were in the prior year. And for that, you could see how close they were to the standard deduction. In other words, single filer's standard deduction is 12,400. So you might ask yourself, well, how close were they to that last year in terms of itemizing? If they're close to that, then you might want to figure out the itemized deductions to see which one would be better. Notice again that you're only going to get a benefit from the itemized deductions for the amount that's over the standard deduction that would be possible. If they're married, then the threshold jumps up to 24,800 because you have two people now together. The threshold then doubling for the standard deduction, doubling for whether or not you are going to be able to itemize or not. And for head of household, we have the 18,650. So these are the items you want in your mind. You want to be thinking 12,400 is the standard deduction, and then basically it doubles if married, and then it goes up to 18,650 if you're head of household. So I would think of 12,004 as the standard, and then you're thinking, okay, if they're single, do they have itemized deductions that are going to be up to that? If they're married, well, now it's doubled the standard deduction, 12,800. Do they have itemized deductions that are going to be higher than that? Are they worth me getting into? And then where the itemized deductions are going to be on Schedule A. So if we jump over to the Schedule A, here we have it, itemized deductions. The categories are going to be at the left-hand side: medical, taxes you paid, interest, charities, casualty and theft, other itemized deductions, and then the total, which will be calculated down here where we have the 1,060, is the number that has to be greater than the standard deduction in order to be taking the itemized deduction. As of now, of course, this number is less than the standard deduction. Therefore, the software is picking the standard deduction as the deduction that we're going to be taking. Now, note that, again, you would typically look at the prior year to see if they have gone over the itemized deduction in the prior year to see whether or not you want to talk to the client about gathering all this information that might be putting them over that point. And then oftentimes when people, move on in their lives, the thing that pushes them over will often be the purchase of a home. Now, if they purchase a home, they're probably going to have a mortgage on the home, and they're going to be paying interest on the home. And that's usually the indication. And even if they do not tell us that, which they probably will, we're probably going to get a 1098 about it showing the interest that was paid. And then if they pay interest on the home, they also probably paid property taxes, which are a state tax, also deductible for federal income tax purposes. and also might be on the same form that you would get for reporting of the interest, the 1098. So let's just take a look at that first. Let's pretend we got interest here. That would be the home mortgage interest. That's usually the thing that would kick people over. And we'll say, all right, well, what if they had interest, let's say, of $10,000 here that would be reported on the 1098? And then let's say they had taxes, which would be property taxes. We're going to say a state or local tax on the home. And let's say that was another 3.5, let's say. And then if we go back on over to the forms, then now we've got these items for the taxes. The 3.5 is there, and we have the interest of the 10,000, and we're adding up to, if we add everything up, the 14,560. That 14,560 now being greater than the standard deduction of the 12,004. Therefore, we're taking the deduction of the 14,560. Now note, as we go from the standard deduction to the itemized deduction, we really only got the benefit of the difference between the two, meaning I would have got the 12,000 anyway. So when I bought the home and I paid the interest on it, now I've got a deduction of 14,560, but I would have gotten 12,004 anyways. So really the deduction that I'm benefiting on is 2,160. So that thing that kind of jumped me over to being able to itemize is only benefited me to the point that it helped me to clear over the standard deduction. And that's kind of important to realize when you're talking to people about, when they say, I want to, buy a home simply to be able to itemize or something like that. They want to understand exactly, what they're getting. They didn't really get a benefit of possibly the whole 10,000 even of the interest plus the interest. They got the benefit of the difference between the standard and that itemized deduction. And that has gone down since the standard deduction has increased. So that's just something to understand when you're talking to people about it. But now that has cleared the threshold, now that we have cleared the threshold for the itemized deductions, then anything that would add to the itemized deductions will be a benefit. So now it's worthwhile to see if you can get all your charitable contributions and anything else that might fall into the categories of the itemized deductions. So now let's think about that. So now we're at a situation where someone has cleared the itemized deductions, and then we could think about each of these categories. I'll go over them in more detail in a future presentation, but let's just think of them in general now. We've got the medical and dental expenses. Now note that these medical and dental expenses have to clear 7.5% of the AGI before you get a benefit from them. So they're still severely limited. If you have someone with a high income, you still may not get any medical or dental even though they're itemizing. So if I jump, for example, and I say I want to look at prescription drugs, and let's say I put in here $1,000, and we're going to go back on over to the forms. So now we have the $1,000 that would have been deducted, but you can see it pulled over the 100,000, which is basically the adjusted gross income on line on the 1040. If I go to 1040, here's the adjusted gross income of the 100,000, basically pulling over here, and you're taking 7.5% of that. So I have to clear then 7,500 before I get any benefit. So even though this would count, I have to clear that threshold. So not only do we have to clear the standard deduction, but we also have to clear the 7.5% threshold. And that means if you're a higher income individual, the higher your income, the harder it will be to clear that threshold. Taxes you paid. Notice that we put the tax here related to the tax on the property. We're imagining that's the property tax. But also we might have state tax, which could be either sales tax or the income tax. So remember that this category represents basically state taxes, because we're talking about federal tax return. The 1040 is calculated federal income tax, and the state income tax is what might be deductible, or the state taxes in general and local taxes may be deductible for federal income tax purposes. You can't deduct federal income tax on the federal income tax return. That would be like a circular loop type thing. But you might have state taxes that could be deductible. Now the software is calculating, because I said this was a California return, is calculating the income tax for the state because I'm calculating the California return. So software will help you to do that, to calculate the state tax, and it'll depend on how the state is taxing. Also, what might go in here is other kind of state taxes You might have like a car DMV related tax or whatnot that could be deductible here. But the main ones are going to be the state tax, which could be the sales tax or income tax, depending on the state you're in, that might emphasize one or the others. And then you could have then smaller taxes that could be, and then the property tax are typically the two big ones, generally on property such as the home, the property taxes on the home. And then you could have other taxes that could be included there. Interest paid. So when we're thinking interest paid, we're usually thinking about the home mortgage interest as the number one interest. It's not everything that could be included here. We'll get into more detail on it later, but that's the big one that you're thinking. And you're thinking, do you have a home? If you do, you have a loan on it most likely. What's going to be the interest on the loan? Gifts to charity. So the gifts to charity would be here. And notice these don't have any caps on them like the medical does. We got this cap here. You got to clear over 7.5% of AGI. Not true with taxes, not true with the interest, and not true with the gifts. So gifts to charity, typically or prior to the change here, you can only get this on the Schedule A. If you gave to charity, you really only get a benefit on the Schedule A. Now, even if you standardize, you do have this 1040 line item here on 10B, but that's capped at $300. So you can still give $300 and get a tax benefit to charities on page 1, whether married or single, it's the same $300. And then you could go over that, and if you're itemizing, and give more to charity, and we'll talk more about the restrictions of it, but that would go on the Schedule A. So it would only benefit you beyond the $300 if you had the Schedule A and were itemizing. So we'll talk more about that in the future. You can also gift things that aren't cash here, and we'll talk more about that in future presentation. Casualty and theft losses. This used to be a broader category, and they have now condensed it a lot. So casualty and theft losses from a federally declared disaster other than net qualified disaster losses, attached form 4684. So it has to be a federally declared disaster, which, there have been, some zones here in this year. So that very well will qualify for many people. But notice before this, it was before like 2 years ago change. It was a broader category. It's probably good for tax preparation purposes in general that they narrowed it, because that could be a place of confusion before. So in any case, so that's that one. And then we have the other itemized deductions we'll talk about in a future presentation. It's a fairly limited spot here, and that'll give us the total itemized deductions at the $14,560. Now notice this $14,560 is flowing forward to the 1040 here as a single filer. What if we were then saying that it was a head of household, it wouldn't qualify, or let's say they were married. Then if we're married, the standard deduction is going to jump up to $24,800, and this item will no longer push us over the cap. Let's check that out. Let's say Eric's getting married here. Eric's getting married again. We're going to go back to the client information and say that Eric got married again. Married filing joint to Jane, Eric and Jane. So if we go back on over, now we got married filing joint. And if I go down to the standard deduction, we're at the $24,800. $24,800, we're not taking the itemized deduction. You can see Schedule A is gone because the itemized deductions are not greater than, if I go to A, than the standard deduction. So here's what we got on the itemized, not greater than the standard deduction. So this would have to clear the threshold. So if I was to jump on back over and say, all right, what if the mortgage interest was all the way up to 17,000, and push on back over to the forms, then now we're at 21. It's still not over the 24 threshold. So let's say the property taxes here, taxes on the property. Let's say this was 6,500, and then go back on over and say now we're at the 24,625, and we're still not there. And let's say we gave to charity here cash contribution of 5,000 to charity, and that should push us over. So that's going to push us over. So note that's a pretty high threshold. So again, if you're talking to someone or a broker, or like a real estate broker, that's saying you could get this huge deduction if you take out the loan on the home by buying a home. You're only getting the benefit if it clears of the amount that clears the threshold. That's kind of important to note, because now I've got a 29,625 amount here, but really I'm getting the benefit only of the amount that cleared the 24,800. And that's kind of the point of the simplification of the tax code when they did that, so that you don't have the itemized deductions for the, more people are not itemizing, because it kind of benefits people only. It often benefits people that are more well off, that have more, like if you have multiple homes or something. But in any case, so that is going to be that. So there's the 29,625. Now, if you were to mirror this on our worksheet over here, you could say, okay, now we're taking the itemized deductions, which I would then pull over to the Schedule A, and then I would put the same information here separately. So oftentimes, if you're going to put items in here, and we'll practice this more in future presentations, but I would be taking the mortgage interest directly from the input form, and again, we'll practice this in the future, but I would try to get this from the documentation. I'm not now because I made it up, but 17,000, right? I'd take that from the documentation. I would take the taxes from the documentation that I have from the client, and that might be on the same 1098. So the taxes here was the 6,500. So I'm going to say that's the 6,500. And then if there's any DMV, now the state taxes, however, I'm going to be reliant on the tax software to calculate the state taxes if they're taking state income taxes. So that I kind of have to pull, and I would pull that, usually the last thing would be the 1,125, right? The 1,125 to get to the total taxes of the 7,625. So there's the 7,625. And then the charity, again, I would double check by entering it here from the source document, not from the tax return. Would be, I'm going to say 5,000 here, and that's going to add up to our totals of the 29,625. Here we're at the 29,625, and then when I pull it over, it's going to be in this line. So if I go back to the itemized deductions, I'm pulling this line over, and then here I should be taking, I'm using an if-then formula, which basically says take the one that's larger. So I won't go over the formula now, but we're taking the bigger one here. Now the standard deduction is married filing joint. So now it's taking the bigger of the two, and you can kind of compare them in your worksheet here using this formula now. And so now we've got our 100,000 minus the now itemized deduction, getting us to the taxable income of the 70,375. And then I can go back on over and say, if I go back to the 1040, we've got the 70,375. So hopefully you can kind of see, like, the itemized deductions. If you're doing those, you're doing a lot of data input that you could have key errors, entering the wrong number somewhere. And if you double check it on the formula worksheet over here, enter the data not from the tax return or the software, but from the source documents as much as possible, then you can kind of double check your numbers here and give yourself that double verification. If you're working in an office, a CPA office, then you might actually have two different people do these things, and then you can bring them together and compare them, and that can give you basically an internal control that you're entering the data properly, or that you didn't make a keystroke error, because there's no double entry accounting system that's really there's no balancing mechanism. Assets don't equal liabilities and equity. We're only entering the income statement. And therefore you want some kind of verification fact. That worksheet can give you that double verification.